Something very interesting is happening with Ethereum. In just 6 trading sessions recently, almost $1 billion has flowed into Ethereum ETFs. One publicly traded company now holds approximately 4.8% of the total Ethereum supply, and some of the world's largest financial institutions, such as BlackRock, JP Morgan, and more, are launching tokenized funds, stablecoins, and financial products all across Ethereum. So why does this matter to you? On the surface, it seems very much like smart money is choosing Ethereum. But there is a problem with that statement, and we're going to get into that. Because an individual holding an Ethereum or an investor buying a BlackRock Ethereum ETF, BlackRock launching a tokenized fund, and Robinhood building an Ethereum layer 2 are not the same thing. So today, we're going to follow the money. Who is actually buying ETH? Who is simply building on Ethereum? And does institutional adoption automatically or necessarily make ETH a better investment itself? And just a quick one, just before we go any further, as always, these videos are for education and entertainment purposes. Does not constitute financial advice. But if you value the content of what we're saying, founder level analysis of financial markets and crypto without the moonboy type of hype, please like the video and subscribe to my channel. So before we're looking at numbers together, we need to ensure that we understand there are 3 different groups here. First of all, there are capital allocators, such as funds, gaining price exposure to Ethereum through ETFs and investment-related products. Secondly, there are Ethereum treasury companies, such as BitMine, buying ETH directly and looking to generate yield from it. And third, there are institutions choosing Ethereum as the infrastructure and settlement layer without necessarily making a directional bet on whether the Ethereum price goes up or down. All 3 of those groups are significant for different reasons, but really it's only the first 2 that represent a direct demand for the asset. And even at that, we need to ask the question, whose money is actually being invested here? And also, why should you care? Well, when there's so much bullish noise and news surrounding Ethereum, it's important that you can understand the difference between noise and signal. The signal being the important facets as to why it is important for you to maybe, or maybe not, have exposure to Ethereum as an individual and or a group or institution. So let's dive in. The ETF money has returned. The clearest evidence of renewed demand for Ethereum is the US spot Ethereum ETF market. And for those of you that don't know what ETFs are, it's worth just having a quick look up yourself. But if I can quickly simplify it, it's basically an asset type which holds tiny pieces of lots of different companies. In the case of Ethereum ETFs, in this instance, it's owning tiny pieces of different companies that have direct exposure to Ethereum. In other words, rather than just having all in on one company's stock or share, in this instance, you're buying an ETF that has lots of different pieces of different stocks and shares. Now, according to Farside investors, Ethereum ETFs recorded approximately $71 million in total across the ETFs on the 18th of August, 186 million on the 19th, 219 on the 20th, 184 on the 21st, 115 on the 24th, and $179 million on the 25th. Finally, the 26th, yesterday at the time of recording, another $192 million in buy spot demand across Ethereum ETFs from some of the biggest managed funds in the entire world. Not including the 26th of August, this accounts for $960 million in spot ETF demand over the past week. And on the 25th alone, you'll see that the ETHA BlackRock product accounted for $146 million of the total $179 million for that particular trading session day. As sometimes you will see this described as BlackRock bought $146 million in Ethereum on the 25th of August. It's technically not true. Practically, ETHA must source ETH back to investor inflows, so it does create real demand for the Ethereum asset. But technically, that capital came from investors buying shares in BlackRock's ETF. It's not actually BlackRock themselves deploying $146 million from its own corporate balance sheet. However, the headlines are clear. 6 trading sessions, almost $1 billion in ETF inflows, and almost $750 million of that via BlackRock's ETHA. That is not insignificant. In totality, The Ethereum ETFs collective has generated roughly $12.5 billion in cumulative net inflows. But the important distinction here is that when money enters BlackRock's Ethereum ETF, it doesn't mean that BlackRock itself is purchasing Ethereum or making a multi-billion-dollar bet on it. It means that BlackRock's clients are choosing to gain ETH exposure through the products it offers. Now, this is still institutional adoption, but it is more so evidence from BlackRock's customers, not necessarily automatically a conviction trade from BlackRock itself. And I urge my viewers to be aware of the difference in the distinction. Now, the corporate treasury story is far more direct. As of August the 24th, BitMine Immersion Tech announces ETH holdings reaching 5.85 million tokens and a total cash and crypto holding of almost 15 billion, 4.8% of the total ETH coin supply of 120.7 million, and more than 5 million ETH has already been staked. Now, this is not an institution experimenting with ETH and blockchain technology. This is an enormous, concentrated bet on Ethereum itself as an asset. And BitMine aren't alone. SharpLink, another corporate holder of ETH, recently provided an update of its own ETH strategy. Here we can see as well that their ETH holdings are almost 889,000, generating revenue yield $11.5 million. They are trading publicly on the Nasdaq under SBET. So similar to BitMine, unlike Ethereum sitting in cold storage, these companies are staking ETH as part of their treasury to gain yield. And this is a huge part of Ethereum's institutional appeal. Bitcoin offers scarcity. Ethereum also offers scarcity, but it also offers opportunity for staking and access to the on-chain financial system. But let's be clear, this is not risk-free smart money. Treasury companies often fund these purchases through issuing shares, raising additional capital, or relying on their stock trading being priced at a premium. If that premium slows down or disappears, practically speaking, that can mean that the flywheel for purchasing can slow down or worse, reverse. We can see here that CoinGecko's treasury tracker currently lists 34 public companies in the top left with total ETH holdings of almost 7.9 million, constituting a value of almost 20 billion and over 6.5% of the total ETH supply. With the breakdown of those different companies here, BitMine being the largest by far and SharpLink following thereafter. Now, the third group is arguably the most important, the institutions that are choosing Ethereum for the rails and the settlement. Why? Because institutions are not simply buying exposure to Ethereum, they are choosing Ethereum and its layer 2 ecosystem as the financial infrastructure. Over the past few weeks, Ethereum Institutional has highlighted a constant stream of new funding, tokenized products, distribution milestones, and institutional conversations. These posts are valuable leads, but Ethereum Institutional exists specifically to accelerate institutional adoption of Ethereum. So we should take this with a pinch of salt. It's not total proof that the argument for Ethereum as the institutional choice has automatically won. But that said, the Ethereum institutional dashboard currently shows the ecosystem hosting over half of the global stablecoin value locked, around 65% of DeFi value across all blockchains, and it holds a leading share of tokenized real-world assets. It also highlights products from BlackRock, Coinbase, Robinhood, and more. And this is the real deeper thesis here. Ethereum is not merely trying to become another asset held on corporate treasury sheets of companies on Wall Street. It is trying to become the very infrastructure Wall Street uses. Robinhood is a really strong example. Its Ethereum Layer 2 reportedly passed 420,000 real-world asset holders, 1.3 billion total value locked, 3.4 million monthly active users, 3.9 million in revenue within the first 6 weeks of launching. The important point here is not just the blockchain, it's the distribution that Robinhood offers with already having tens of millions of customers. It doesn't need to persuade users, like most crypto companies, to download a tricky crypto wallet before offering these tokenized stocks and shares. it can bring these blockchain-based products directly to them in the interface they're already familiar with. Then there is Neuberger and Securitize. In August, they launched a tokenized high-income fund investing primarily in high-yield bonds, alongside collateralized loan obligations and leveraged loans. The strategy draws on a fixed income platform overseeing more than $230 billion. And that is the exact type of product crypto has talked about for years. Traditional assets, portfolio management, on-chain issuance and settlement. But there is another important detail here. The fund is available across Ethereum, Avalanche, Solana and Sui. So in this instance, this is evidence that major institutions are choosing public blockchain rails, but it is not necessarily evidence that it has exclusively chosen Ethereum. So why does Ethereum keep making the shortlist of these institutional products? Well, it's not the fastest blockchain, and it's certainly not the cheapest. But the reality of it is, it's been over a decade and it has never gone down. It has proven security, liquidity, and standards that the network has operated on for over a decade. Institutions know they can choose Ethereum when maximum security matters. They can use layer 2s when they need greater speeds and costs. And they can connect tokenized assets to an existing ecosystem of stablecoins, exchanges, lenders, and custody providers, as well as collateral. The network effect here is exceptionally difficult to recreate. Ethereum sits at the center of it. It pays for settlement. It secures the network through staking, and it is widely used as collateral. And to hedge against inflation, Ethereum's fee mechanism uses part of the base transaction fee to be burnt. It's value accrual. In theory, as more financial activity settles across Ethereum, demand for block space, security, collateral, and ETH theoretically grows with it. But the word theoretically is doing some heavy lifting in that sentence. So what are the ultimate cases for the narrative against an ultimate bull case for Ethereum? Well, it's important to highlight that building on Ethereum does not necessarily create dollar for dollar increase in ETH. Users can still transact in stablecoins across layer 2 applications that can capture most of that revenue. And those L2 ecosystems can reduce the amount that each individual pays to Ethereum. So network adoption is great and all, and the token value is somewhat connected, but the one for one of the value in and out is not identical. We also need to consider some perspective on the recent ETF numbers. Before this rebound, Ethereum ETFs finished the first half of 2026 approximately $1.47 billion in the red. DWF Labs counted 73 negative trading days against 49 positive days during that period. So nearly $1 billion arrived in 6 sessions is a meaningful change, but it does not erase the volatility of the institutional demand. It tells us that the interest has returned, but not necessarily that it is permanent. As we can see here, outflows from spot ETFs eclipsed inflows. ETHA lost 1.51 billion. But importantly, we need to reflect on the date. This is looking at the high peak of inflows going back to October through to July this year. It seems there's been a meaningful shift over the last month or so. Citi also reduced its Ethereum target earlier this year, pointing towards US crypto legislation stalling. As reported by Reuters, the Wall Street brokerage lowered its 12-month Bitcoin forecast to 112 from 143 and its Ethereum estimate to 3175 from 4304. And this is probably the most honest summary of Ethereum today. The institutional adoption and infrastructure is advancing. The investment products are definitely attracting capital again, but adoption, value capture, and price do not necessarily move in a straight line. And I recently explored the themes as to why this is when looking at Tom Lee's 250k Ethereum thesis in a recent video. If you haven't seen that one yet, I highly recommend that you go take a look at it. I'll link it at the end of this video. So in conclusion, is smart money choosing Ethereum? The answer is yes, but not necessarily in the simplistic way that a headline would suggest. The 3 entities we referred to earlier, ETF investors are increasing their exposure to ETH. Treasury companies are accumulating and staking the asset at a pretty extraordinary scale, and banks, brokers, and asset managers are using Ethereum to launch real financial products. So the strongest evidence is not a single price prediction, it is that Ethereum keeps appearing at all 3 layers. An investable asset as productive collateral, and perhaps most critically of all, as settlement infrastructure. But smart money, it's not one person buying ETH and making one trade. Some institutions are buying ETH, some are selling products to customers who want ETH, and others are building across several blockchains at once. The question and argument is no longer whether institutions are coming on chain, they are. The real question is whether Ethereum can convert its tokenization, stablecoins, and on-chain finance into sustained demand for ETH, the asset itself. Because then the bigger consideration is not whether smart money is simply buying Ethereum again. It may be positioning around the infrastructure of the next financial ecosystem. I'd love to know what you guys think. Do you think the evidence that I've uncovered is indicating that smart money is choosing Ethereum and we should see continued demand for the asset? Or are we reading a little bit too much into these short-term ETF inflows? I'd also genuinely appreciate it if you could like this video and subscribe to my channel if you want more videos on Ethereum, Bitcoin, the wider crypto market, blockchain adoption, smart money, and wider financial capital markets. Thanks again. I'll see you on the next one.